Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, now that the roller coaster ride has settled down just a little bit in the stock market, at least as we're speaking right now, we wanted to check in with our regular panel members here to see just how they felt and what they think lies ahead. And we lead off with our Executive Vice President of Zacks.com, Steve Reitmeister. Our Research Director, Shiraz Mian's with us as well, again, as is Kevin Matris, our Market Technician. So I like your opening line in one of your recent commentaries, Steve. Sea of investing getting harder to navigate with all the choppiness that's out there. So what lies ahead? What do investors need to focus on?
Yeah, last week, just crazy wild swings, and you said that it seems like it's calming down now. I think that might be a very brief...
I said as of this taping,
a very brief
anyway.
oasis there. But what I'm trying to say is that don't get caught up in the movement of the stock market. Stay focused on taking a look at the economic data. Right now, let's just say we're at a stalemate. The market will go up if the economic data says muddle through or better. The stock market will go down if the economic data says recession. Because right now, I'm in the recession camp. We got two here that are not, okay?
Right.
But that's the way the market is kind of right now. I think it's nearly 50-50, but I think there's a slight edge to those who don't believe in it, which is fine. And that's why the market will kind of sit around here until the economic data proves out where it's going to fall.
Right. And that includes the lagging indicators as well, because they have not all confirmed yet.
Yeah, right. If you wait, though, for every single dot to line up, do we have a recession? It's going to be a little bit too late for the stock market right now. But right now, you only have a few that are indicating that. And I just think it's the tide of where things are going. But I am not, as I mentioned in the video last week, I am not 100% certain of this outcome. I'm about 70% confident that there's going to be a recession. But it's that that little piece that's left, I can't go whole hog short until I see the economic data prove out. Okay,
well, that makes sense. That's fair. So, Shiraz, you are one of the most optimistic people here at the table anyway, you and Kevin. It's being said that the market is efficient as far as a long-term processor of data is concerned, but in the short term, it can get kind of panicky.
It does. And many times when it is sizing up these completely opposite views, like the way Steve articulated them, whether we are going into negative territory, no, we are not. This could be extremely choppy, and we saw that last week, and in fact the last couple of weeks. I think, in my reading of the data today, tells me that there is plenty of positive momentum in the economy's underlying fundamentals to keep it afloat. It's not going to be very strong growth where you're going to have impressive consumer spending and unemployment will come down, but it'll be high enough in the 1.5% to 2.5% range to keep us in the positive. We had good retail sales number last week, and if we extend that into the entire third quarter, that'll give us personal consumption expenditures in the 1.5% to 2% range, which would be a significant improvement with what we saw in the second quarter. And the jobs picture, if it's not improving, it's not deteriorating either. And that's another positive. So if you have retail spending, consumer positive sentiment, and these developments on the labor front, they don't tell me that we are heading towards a recession.
Yeah, Steve brought up a good point before we started taping, when we were just talking here among ourselves about consumer sentiment, and predicting stock markets in the past.
I looked at a chart. The last four recessions, the consumer sentiment numbers before that were at levels where we're at now, or even a little bit higher, meaning that we are definitely signaling a recession as far as the consumer sentiment numbers are concerned. But I wouldn't say that is the best indicator of what we have going, but it's certainly indicative of a potential direction, yeah.
All right, Kevin, while we're keeping our eye on consumer sentiment, what are the technicals telling us?
There still is a downside bias, but if you were to look at the technicals, I believe that in the Dow, you could actually see a retracement all the way back up to 11,800. Looking at the S&P, you could even see the market get as high as 1250. Now, I don't think that you're going to see the market get much higher than those levels, and definitely I don't think you're going to see the market make new highs until we get more economic data. But if we see better economic data in the interim, I do believe there could be some more upside. Now, we got some interesting data really in the last couple of days. Here in the U.S., the Empire State Manufacturing Survey came out. It was absolutely terrible. We actually contracted by 7.72%. Or excuse me, the reading was minus 7.72. But if you were to look at Japan, which I believe was a very good thing, they showed that their GDP was only down 1.3% versus the expectations for minus 2.5. The reason why this is so important is because a lot of analysts and also the Fed had attributed a lot of the U.S. slowdown to the transitory effects from the Japanese earthquake and the tsunami. So if Japan is able to rebound quicker than expected, that means the negative impacts to the U.S. should dissipate quicker than expected as well. So I think that there still is some more upside.
Okay. Steve, give us your top pick.
I'm going with DGP, which is a 2x gold position, meaning it should go up 100% greater than the price of gold, or 200%. Twice as much as gold. And simply at times of uncertainty, times of crisis, gold has done very well. And then when I look out a notch further, that if we do head into recession, then I think that our government and maybe other governments around the world will do some kind of stimulus or quantitative easing, which further erodes the value of the dollar, which makes gold that much more valuable. So I think it's good in times of crisis, good in times of government excess.
Okay, Shiraz.
Priceline.com, well-known name. There are some questions, as we all discussed, about the consumer, about the macroeconomy, but Priceline has enough of a first-mover advantage in the travel and in the leisure space that they have plenty of secular growth momentum behind them. And as this overall sentiment stabilizes a little bit, not necessarily improve, stabilization would push Priceline shares higher as well. That's my pick for the environment.
See, while you guys are feverishly looking at the market day to day, he's thinking about vacations. Proves he's optimistic.
I do like Priceline, by the way. I like that stock.
Kevin.
Mine is the Technology Select Sector SPDR ETF, ticker XLK. Basically, this is an ETF that focuses in on big tech. So it holds things like Apple, IBM, Google, Intel, these kinds of things. I believe tech is really going to be one of the big winners in the coming months and in the coming quarters. Businesses have thrived because of their use of technology. And all of the best innovation is coming out of technology. So I believe that this is a good space. I like the ETF too because you don't have to worry about specific individual stock risk. You're looking at the entire group. Looking at my price target, I've got a price target of $30. That is a 25% increase from where we are today.
All right. All levity aside, you can be sure of one thing, and that is that these three gentlemen are going to be keeping their eyes peeled on what's going on in the economy and the market to bring you their latest thinking. So you should be keeping your eyes peeled right here to Zacks.com for that latest thinking. With everyone here, I'm Terry Ruffalo.